Investors own 1/3 of all properties. Is that the problem for why prices are so high? Stay tuned as I break this down for you in this week's episode of Prime Property. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Properties TV. So glad you could join me here today. On this week's episode, we're going to talk about 4 major things. The first one being, do investors own too much of the properties? The second one being the wealth gap that's being driven by real estate. The third one being inflation targets. And the fourth topic we're going to talk about is about condo assignments and the speculation frenzy that's going to come into all of it. But the first thing I want to give you an idea of kind of what's happening in the current market right now, because there's a lot of things shifting, is kind of my sentiment and what I'm seeing right now. The market came to a complete halt basically last week. Now, granted, we could say it was Easter, but it was really, really, really bad. I would almost classify this as like buyer's market level of like no showings and no offers. And let me show you what I mean. So I have over here, this is some data taken from Broker Bay. It's not like super accurate, but what I can show you over here is that this is kind of a steady increase in the amount of showings we've had. And you can see here, this line right here basically starts January and we get quite really high up to about 100,000 showings per week. And you can see how we've kind of just fallen off, right? Now, there's a couple days I wasn't included in here, but the fact that we're trending down so quickly is problematic for kind of still being in a seller's market with so little inventory, but it's a buyer's market as in people aren't actually visiting these properties because it's kind of like a funnel, right? You need to see the property, like the property, make an offer, multiple offers, whatever, buy the property, and there are conditions now, and then sell the property before inventory gets absorbed. But if the first part of all of this doesn't get fixed up, meaning that people aren't seeing the property, we have a big problem. Now, the second thing over here is that chart over here, it says number of offers, right? So again, not every single brokerage uses this, but I would say a majority of big brokerages use this. And it's showing you that the decline of number of showings has kind of started, like we were saying, around late February to March. And it's kind of slowly declined, and now we're getting barely anything. And a lot of people are going to attribute this to, and specifically the politicians, they're going to say, hey, look, the federal budget did its job, right? But or the Ontario said they increased the foreign buyer tax from 15 to 20%. But look at it this way. The sentiment was already kind of slowing down towards end of February, and nothing's changed from a government intervention perspective. And these are the things that I always talk about, like we can't foresee what's going to happen. They can talk about it like 1 month in advance, but there's all these things that's working in the background. There's only so much you're going to hear from the grapevine. And when the market was slowing down just from regular fatigue, because people were just like throwing money, like 50 plus offers at these things since like November, December, and then January and February, they get exhausted. Most people do get exhausted. And then when we saw the interest rate hike come in, the first one, like the 25 basis point one, then what we saw is that the market slowed down, but it didn't come to a screeching halt. And then you got the federal budget and then the foreign buyer stuff that come in. And then last week we got the 50 basis points, and now everyone's like it's just frozen. That's kind of where the market is right now. But if I want to look into each macro perspective to give you an idea what's going on, I would say, if you're looking for a condo in Toronto, specifically one with parking, if you're sub like 750, still moving, some showings, like 1 or 2 offers. I have some clients looking for some $1 million condos, and that stuff's still kind of moving and has a really great view. That stuff is moving. Everything else, now when you're looking for, say, one of these 4 and 6 detached homes, like a family home, whether it's entry, 3-bedroom, 1 washroom semi, or like a detached, that stuff is still moving. I'm still seeing multiple offers in like North Toronto, which is Yonge and Lawrence area, Leaside, Plater Estates, and the East York, like the Riverdale area, and I'm also seeing stuff move in Roncy. So those are kind of like the pockets where people want to move to because of schools. And like I was telling you last video, people who move for school districts and keep their kids in the same school district, doesn't really affect them, right? But people who are just trying to buy maybe for the first time, right? Or maybe doing a transition because they want to, not because they need to, they're kind of on pause right now. Then everything else in the now 5 is, right? There's no showings, no offers, no nothing. No one has any interest in any of that stuff right now. And anyone who is selling right now, they're probably just looking for anyone to even show any remote of interest. And those sellers who need to sell because they bought something already, then they're in big trouble, because especially if they're selling something at 905, then they're at the mercy of having to close that one and needing the money from their existing home. This is why, like, if you're going to sell something, you have to be very careful in how you do this, right? Because the market can shift really quickly. And I saw this in 2017. And this is why I'm very cautious when people do a move. Now, right now, I would say we're very similar to kind of the feeling in the real estate industry for how 2017 was compared to now. Very similar. So when we came to a halting screech, everyone's like, party's over, whee, right? So you really have to be careful what you're doing in the real estate market. I would say sellers, unless you absolutely need to sell, don't sell right now. Buyers, if you don't need to buy, especially my investors I've been talking to, you don't need to make any action right now unless you can absolutely find a deal. I've been always saying, hey, look, when there's an opportunity, I'll let my clients know, and the opportunity is still not right now. So if you're my client, you'll know way in advance. Having 50 basis points come in still takes time for it to trickle into the market. So nothing is kind of, say, opportunistic right now. It's still very much no one's knowing what the hell's going on right now. Now, if you are buying something for your end user and you're trying to just look at properties, now's an opportunity where you can find something that a lot of people may like. You may encounter some competition, but it's gonna be a lot less competition. And again, only do it if you're using the property and you are kind of needing it to move to the next step. But I wouldn't do it just because you want to, kind of thing. Because right now, the market could go rebound, the market could also come down. No one has any idea right now. And I'm gonna talk more about this with the inflation expectation on the interest rate. I do think another one's coming, like I've been saying for a while. There will be one in June, and that's probably what a lot of people are waiting for right now. So let's move on to the first article. Multi-property owners own significant portion of housing in Ontario and BC, news report shows. This is gonna drive a lot of eyeballs because everybody who isn't in the market, I would say, is looking for the next person to blame after the foreign buyers. It always just teeter-totters. I think the word on the street is people want to blame investors. The word on the government side, they're still kind of trying to blame foreign buyers. And you can see this with federal budget where they banned foreign ownership, but they did nada, zero, didn't talk anything about investors, right? And you're gonna see this kind of theme I'm gonna talk about. Now in this here, there's this chart saying that they did and studied CMHC in 2017 or so, and they started collecting data about who owns what. And here you can see in Ontario that 15.5% of people who own properties own multiple properties, meaning that 1 in 6 person who owns a property owns another property. And of all the properties out there, these 1 in 6 people own almost a third of the real estate in Ontario. That's kind of a startling number if you think about it, because it's kind of like this. If you walk down the street, every 6th person you see, one of them owns a secondary property, and that person probably owns the big pie of the third, meaning that 1/6 of the people in Ontario own 1/3 of the real estate. That's kind of how these charts are kind of set up. In BC, it's kind of more or less the same. But my argument with this is two things, and one is going to be about condo pre-construction, which I'm talking later about the assignment. But the second thing is there's a lot of people who own properties under certain different names to qualify, but at the same time, it's very difficult to quantify how to frame this statistic. And I'll give you an example here. So if you look at Nova Scotia, it says that 1 in 5 people own basically almost half the properties. Wouldn't that be more speculative if you look at those numbers? Especially if Nova Scotia and New Brunswick properties should be lower in price. So it's very hard to frame. But what I can say is there's definitely a lot of investors out there. But is it the sole reason why end users can't buy homes? I would say not really, but they definitely add to it. But the problem is how these investors, and most of them are investors, are generally in the condo space. And we'll talk a little bit later, because end users don't buy pre-construction. It's always investors. You need the investor base to drive the supply side for end users, but more on that a little bit later. Now, the thing that they did address here is that this is data taken before the pandemic, and I would say these probably numbers skew more towards more investors owning more properties after the pandemic than before, because interest rates got really low. So it's probably worse than this. So you can read into this how you want. I think if you were to look at it from like a very pragmatic perspective, the investors are kind of like a necessary evil that you need to have to create more supply. Kind of like if you were to have wildfires, you need a couple of them to cleanse all the dead stuff. Some of it is necessary. It's a painful kind of transition, but you need them, right? And I think that's kind of where the investors slot in. Are they going to have a target on the back? Absolutely. I've been saying this for years. Right? Here's the thing that I kind of highlighted in green for you guys earlier, saying that if 1/5 of the people owners held properties within the same census, New Brunswick and Ontario said that these have the most secondary properties, but they're pointing it from a narrative perspective as these are recreational properties, right? So it's a really interesting way that Globe and Mail is framed. I'm not saying investors aren't the problem, but I'm saying that they're not all the problem as this article is framing. It's kind of like I was saying earlier, it's a necessary evil. Now, what is the most interesting thing about this is this person named Andy Yan. at Fraser University says that to even out the playing field, someone needs to help the first-time home buyers and not the people looking for their second and third home. And I've said this many, many times before. If the governments really, really wanted to do something about helping first-time home buyers without kind of stoking fire to the flame, you would create a longer amortization period for first-time home buyers so that they can stretch their payments longer and get into the market. It's not going to be the smartest for first-time home buyers, but that's how they're going to get into the market, because otherwise they're going to make everything tank. And if everything tanks, who do you think is more likely to buy something? People who have money on the side with multiple properties, or the person who is so afraid of buying their first property? Because the difference when I work with first-time home buyers and investors is the investors sometimes just see the numbers, they're like, Zhen, that works, let's buy it. And some of them don't even look at the property. Whereas the first-time home buyer, they ask questions about everything because they've never gone through the process. So when prices come down, those who can buy in those times are investors. And for us to level the playing field, we need to push way more incentives for first-time home buyers and let them get into the market, and also increase the down payment, like I was saying, that we should have for investors. But they didn't, which says a lot of things about what the government's trying to do, right? So next article. Toronto's new wealth gap is driven by real estate, not income, where those who got in early can live a very different life. Absolutely true. And I've been saying this for so many people, and a lot of people give me grief about it, saying, hey, Zhen, you're just trying to be a realtor. I've told all my first-time home buyers that work in my life, just get in the market, period. Because your incomes can't chase 3% appreciation on $1 million asset. That's $30,000 a year in appreciation. Your incomes aren't chasing that. Period. It's gone to the point that's so high that if there's a crash, they're too scared to buy. If you're not in the market, you're going to get outpaced. So I've been telling everyone, just get into the market, because then you can trade in the market at the very least, right? And it has costs, unfortunately, but at least you can trade with it. But when you're constantly chasing it, it's going to be very, very, very difficult. And I see this with a lot of high-profile clients like engineers and lawyers who have a hard time in getting in the market as well, because saving for the down payment without family help and qualifying at the mortgage is super difficult while the market continues going at a blistering pace. And this is even before the pandemic. Now, when I scroll down here, there's a very good line over here that I kind of highlighted. Let me find it for you, that I really, really want you to appreciate. To go from owning one home to 2 houses is much easier than it goes from 0 to owning 1, which is exactly what I've been saying. Get into the market if you're a first-time home buyer, because trading in the market is a lot easier. And this is kind of the problem with high prices and wages not catching up, right? And I saw this years ago. When you have interest rates drop, and this was even, again, before the pandemic, the cost to borrow from yourself is so much easier because you now have built equity as the market goes up to borrow from yourself and buy a second property, because you can use rent to offset that mortgage, than it is to get into your first home. Because buying your first home, your income is static. You have nothing to trade with, and it just continues going up, and you have to keep chasing the market. So this is kind of the problem that's kind of built into the system. It's nobody's fault. It really is. And not to get all money nerdy for you, but if you fix the money, you'll fix a lot of these problems. The problem is we're built so much on credit, right? And when you have an asset that goes up in value, you can always keep refinancing and borrow from it over and over and over again. This is why I tell a lot of people, if you understand this, Elon Musk and Jeff Bezos, who are really rich, they don't pay many taxes because they just keep borrowing from that asset that keeps growing in value, which is Amazon and Tesla. And this is the same thing with all real estate for people in Toronto. If the value keeps going up and you keep borrowing from it, you're going to just keep trading assets and building up that portfolio. Whereas if you don't own any of that stuff, you can't borrow from it. You're just always chasing the market. And that's kind of the problem. Unless you provide some kind of crazy incentive for first-time home buyers to actually get in the market, and then you stymie the investors from actually getting in, they're going to have a hard time fixing this problem, which is why I was always saying, hey, you should increase the amortization for first-time home buyers to 40 years, make it so that when they get stressed at, they get stressed at a lower monthly payment, right? Because it's stretched longer for the duration of the period of the mortgage. And you also make it harder for investors to get in. So instead of just 20% down, maybe do 30, 35. But again, none of that was talked about in the federal budget. So you know where this is going. Like I was saying earlier in the last article, this government keeps propagating property prices to go up. And if property prices do come down from a crash because of these interest rates, it's the investors that are going to jump in, not the first-time home buyers. Guaranteed. Now, there's 2 other things I highlighted here for you that's going to be interesting here, is that if there is a price that comes down, The worst case is you have people who lose equity and it's still not cheap enough for first-time home buyers to get in. And I've talked about this many times before, right? Where you can borrow about 5 times what you make in income. So for you to get in, let's say you make 100 grand on the average between 2 people, you would need the prices basically fall 50% before they can get in. But if half the people lose 50% of the equity, then we're in a big problem, really big problem. So it's kind of like the government's backed into a corner and there's really not much they can do. So it's just credit creation. You have to keep going up. And then the last thing is that there's a lot of people who are retired relying on their house to actually go up in value because of pensions and all that stuff I'm going to get into. But this is kind of where politicians need to pander on both sides when they make these policies. And it's very, very difficult because it's like, who's correct? If I'm looking at this, right, you see the back of my hand, I see my hand. I say I see my palm, you see the back of my hand. We're both correct. Both of these things are correct. But the problem is, I can't see your perspective and you can't see my perspective. And that causes a populism drive when there are those who have and those who don't have. And that's kind of the problem we're going into right now. Now, the third article we have here is Bank of Canada's inflation focus suggests another large rate increase, economist says. So in 2021, the end of it, I was saying that, hey, we're probably going to get about 3 interest rate moves, which equates to about 0.75. We're already at 0.75, and I'm still confident we're going to get in June 1, which means I am wrong. Now, the thing that I think I came wrong into, and I have no issue with being wrong, it's more about if more data comes into me, I need to be able to pivot and change my perspective. And seeing a 50 rate hike tells me that they're really serious about fighting inflation. And I keep putting it in quotation is because they're still trying to fight a forest fire with a garden hose because inflation is like 5% right now reported and they're fighting with 0.5. It's not making a difference. And increasing interest rates not going to free up the Shanghai port that's basically in lockdown right now. It's not going to stop the gas and wheat crisis that we're probably going to see because of the war. It's not. But let's just say it is, right? Because now they got to look like they are. I wouldn't be surprised if we probably see 1.5 interest rate hikes. So probably another 0.25, 0.25, 0.25, or 0.5 and a 0.25 for the end of the year, which means that the variable is probably going to get very close to touching the stress test rate if the banks don't reduce their discount. Or what's going to happen is because these rates are so high, everything's just going to freeze. And for those of you who are in real estate for long enough, you'll understand this. This is probably very similar to 2018 when we went from 0.25 rate to 1.5. It kind of froze the market. But at the same time, if you haven't been around long enough, you don't understand the impacts of interest rate. So that's why whenever there's short-term volatility between 1 or 2 years, you got to have a long-term 10-year horizon about how to hold real estate. And when you only think short-term, that's when you look at these things and you're like, oh, crap, the world's going to fall. It's not. It's just you have to know how to hold this asset for 10 years. Now, there is this lot of talk about holding the kind of overnight rate on the neutral rate, which is somewhere between 1 and 3. They're trying to get to the higher upper end of 3. And my belief has always been this. Something's going to break in the market because of the interest rate going up. And just because you're watching this for real estate, interest rates don't only affect the real estate market. It affects a whole bunch of other stuff, like all the, businesses that buy back their stock. It affects them a lot more too. And if they can't hire, we're going to go into a recession because there's job unemployment, right? So the breaking of something due to the interest rate in the economy is probably going to happen, and we're going to see the rates come back down. But I'm of the belief that they need to raise the rates high enough because they're smelling the everything bubble with recession coming, and they need some kind of way to stimulate the market, and which is interest rate, because they don't have so many tools that can do, like the central bankers. So they need to raise the rates as fast as they can. And maybe they're using Ukraine, Russia, and all this inflation to increase the interest rate so that when the everything bubble pops, they have some like interest rates to kind of like drop so they can stimulate the market, right? I don't know. These are just things that I'm kind of looking at right now, and I'm still kind of trying to grasp my thesis. I don't quite fully have one right now because the 50 basis point interest rate did change my perspective quite a bit. Now, the last article we have here is condo assignment sales fueling Canadian market speculation. I'm glad someone finally wrote about this because there's been so much talks about people buying pre-construction and selling the contract and making money. It's not going to work. And I'm going to give you a reason why this is a huge problem. But at the same time, I'm also tell you why most of the investors who are buying these things kind of have to do it this way and why investors are fueling the market. Let me go through it. So they're saying that many of people who buy pre-construction have no intention of selling it. And I'm not going to go too much in the rant here. You can check out the video up here about why you should not assign, but this is kind of what most people are doing. They're not watching that video up there. So what they're saying is that people are trying to buy a property and then sell the contract to it and make a few $100,000, which they have down here. Now, I've always been said and be very critical of pre-construction. And we stopped selling a lot of it in 2018 because very, very few projects actually made sense. Because if you're going to pay a premium on the pre-construction, right? And if the market trades sideways at any point, right? And you're paying, say, call it a 20% premium, and you expect 4% increase every 5 years before the project complete, and then you're at the same price as resale. Fantastic. Sure. Then you can hold that property. That makes sense. And that's what we were doing up until 2018. And then the rents were still matching it. But when you're paying a premium, right, that's 20, 30% higher, if the market trades sideways for a little bit, the property you bought, say, for $1 million, when you get it, it's going to be worth $900,000, which means you're going to have a hard time closing. So what this article is talking about is if those people who are buying don't have any idea of how to close the property or have no intention of closing it, we have a systemic problem in the market in the next 5-6 years if the market doesn't go up by whatever that premium is on that pre-con. Imagine an entire building failing on appraisal. It's ridiculous. It would be crazy, okay? So that's number one. Number two I've talked about is your rents don't make sense. Because if you're going to pay $1,500 a foot, they have the math here saying that you need about $6.25 to cover the cost of the carrying cost of whatever you buy this at. And imagine that, a 300, let's just say 500 square feet place, which is like a large one bedroom in pre-con now, you need $3,000 plus rent for that to carry. It's not happening anytime soon. Like right now, yes, the downtown rents have caught up, but for us to go to $6 a foot, yeah, I don't think so. Like when we were doing pre-con, again, in 2018, rents had to go from $3.50 to $4. The pre-con premium was like 5%. Now it's gone worse. And on top of this, I'm going to talk more about this next week, but the city is proposing an increase in development charges by 50%. So that stuff is going to get passed on to the end users, meaning the people who are buying these things, like the pre-con buyers and investors. It's only going to get worse. That's another problem. Now, here's the final problem I have with all of this. And a lot of people don't understand why I think investors are kind of the necessary evil in all of this, is for these construction projects, these condos to be built, unless you're like one of the big boy developers who don't need construction financing, which is like you need to sell a certain amount, go to the bank, borrow the money, build the place, sell it, and then collect your money. That's how most builders make their money. But if you have a whole bunch of investors over here saying that they're going to get a mortgage letter, right, saying that they qualify for this purchase, and then the builder takes these letters and take it to the bank and say, hey, we're going to build this thing because all these qualified buyers are ready to close on it. But really, if their intention is not, and they can't close on it because that mortgage letter is fabricated, then we have a big issue, because if they come to 5 years, maybe they underappraise, like I said, maybe they aren't going to close, maybe all the assignments come due and none of them ever get bought. This entire building isn't going to get complete. The builders aren't going to get their money. And then the whole thing can go under really fast. So there's a lot of systemic risk kind of built into pre-con right now, which is why I've been very adamant about, staying away from pre-con unless it's a big time builder with a really good value proposition, right? So if all these people pushing pre-construction have this thing at the end where it says free mortgage approval, that means that these buyers who are buying it and flipping it, they have no intention of closing, can't even close it. They're just getting these fake letters done up for the builder to satisfy the mortgage requirement. If all of this stacks up in 5-6 years, we have a big, big problem. It's not even like that person who kind of did all these risky things kind of is going to lose some money. That's their problem. They're just not taking good advice, or they just don't understand it, whatever, I don't care. But the point is, if there's so many of them and they all pile into a pre-con project, that like industry, like pre-construction, is in for a world of hurt. And anyone watching this, you should just be cautious of knowing how this can pan out, because it could be very, very dangerous. So I will leave it at that for this condo assignment stuff. If you are trying to do some pre-construction, make sure you have the intention of holding and closing that thing. If you're trying to flip this, it's a terrible idea. Just listen to my tonality and just really back off, okay? That's it for this week. If you guys are looking for any kind of real estate help, whether you're buying, selling, investing, or trying to figure out whether you should be buying, selling, or investing right now, and again, everybody is different because everyone's financial situation is different, everyone's goals are different, there's different strategies in real estate, you can book a call with me using the link right here. It's www.chatwithzen.com to kind of strategize. And actually, as of late, I've been talking to a lot of people out of buying something right now because we're in flux. And those of you who are working with me, who are my clients, you already know that I've been saying, hey, just wait. If there is going to be quote unquote blood on the streets, it's not right now. It's probably closer to summer. If you have any other topics you want me to discuss or kind of articles you want me to have a reaction to, you can put them in the comment section below. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.